Good morning. Gold is historically a hedge against rising inflation. During times of high inflation and during times when investors expect higher inflation going forward, they bid up the gold price. The price of gold closely tracks the cost of money, you could say. Typically, gold prices move in lockstep with inflationary expectations. This chart shows the inverted real yield of 10-year Treasury bonds in light blue. The real yield is the yield to investors after inflation. So real yield here is the 10-year Treasury note minus the inflation rate, then inverted. Dark blue is the gold price. Over the past 5 years, we have seen very high inflation because the Federal Reserve kept interest rates in the U.S. far too low for far too long. So the gold price just kept marching higher along with the inflation rate. But the Fed started raising interest rates and bleeding excess cash from the banking system, a process known as quantitative tightening. Instead of the Fed buying bonds to keep interest rates artificially low, now the Fed is letting those bonds they bought before roll off as they mature. This drains dollars from the banking system, which leads to lower inflation. So the inverted 10-year real yield is going down, and gold prices should be going down as well. But the opposite is happening. Gold prices continue to move higher. That dotted line, the freezing of Russian banking reserves held in Western banks, was the dividing line between the historical gold relationship to U.S. inflation and real interest rates and the world today, where gold buying is a function of central banks' distrust of Western banking systems. They are buying gold and moving it to their own vaults. Mainstream news outlets miss that aspect of the story and are relying on their own models to explain recent gold price moves. Here is Reuters, which is trying to explain that gold is moving higher over concerns about global economic growth and inflation because of the new tariffs that Trump has announced. But none of that helps explain what this chart has done since 2023. Gold market insiders have a better read on the situation because they know that this is not a story about tariffs or inflation or economic growth. It's central banks, especially in China and India, that are driving the price of gold up. The dollar is getting stronger and real treasury yields are going up, so those should be bearish for gold. What's pushing the price up instead is geopolitical risk. First of all, the Chinese currency is the renminbi, and in RMB terms, gold had its best year since 2009. And in US dollars, the best since 2010. In RMB, gold was up 28%, and in USD, up 27%. So that's not an inflation story, since it's basically the same in two major currencies. And it's also not an arbitrage trader story, borrowing renminbi to buy gold denominated in dollars, because nobody can make money doing that. Here is something else. It's not Chinese retail buyers who are driving the gold price up more than usual. Shenzhen is the hub for China's jewelry markets. Manufacturers and dealers there are reporting seasonal stocking activity, but also report lower sales than in previous years. There was a 26% decline year over year in withdrawals from the Shanghai Gold Exchange, and draws from the SGE are running 34% below the trailing 10-year average. The gold line is the 10-year average draw from the Shanghai Gold Exchange, and it's the best barometer we have of Chinese retail demand. It's below the bar, and in fact, only 2020, a pandemic year, showed lower demand than 2024. So Chinese retail gold buyers aren't buying jewelry, but they are buying gold ETFs. Assets under management for gold exchange-traded funds went from about 50 tons in 2022, more than doubling to 120 tons at the close of 2024. And the People's Bank of China reported another 10-ton purchase of gold in December, on top of the 5 tons from November. Now China's central bank gold holdings are at a record level in their FX reserves. Goldman Sachs developed a model that's accurate at forecasting gold price moves, And Goldman told their investors in September 2024 that gold will be moving higher in early 2025 to a target of 2,900 per ounce. In September, gold was from 2,500 to 2,600. So Goldman was calling for a 12% move up in the gold price to new record highs. Their thesis is here, which combines the impact of rising ETF flows, which is happening, Fed rate cuts, which is not happening, and central bank purchases in London's over-the-counter market, which is happening. 100 tons of physical demand moves gold prices up a minimum of 2.4%. The Federal Reserve is holding steady, not cutting rates, but there is so much action in gold ETFs and central banks that Goldman's price target is almost here. Here's the price today, first week of February, against Goldman's model prediction of $2,900 an ounce. Gold is readjusting its correlations against Western rates. A secret buyer is pushing gold prices higher, and U.S. inflation and interest rates matter a lot less than big foreign buyers who are looking to gold as a hedge against Western banks and holding dollar-denominated debts. And here's what Goldman points to when they refer to China as the secret buyer. Chinese central bank buying of London gold is usually more than the PBOC reports to the public. China's gold purchases in London are consistent with People's Bank of China reporting, but the buys are higher in volume, they start earlier and last longer. And looking at this chart, we can see that the intensity of those differences is up a lot over the last two major cycles. From 2014 to 2017, China's central bank purchases and their public disclosures of their gold buys were the same overall volume. They just reported a year's worth of trailing buys all at once. But China's buying picked up again strongly in 2018, continued through 2020, and their public reporting never really matched. But in 2022, it's undeniable. The early part of 2022, Chinese central bank gold purchases rocketed higher, and they stayed high. And their official reporting acknowledged only some of it. The freezing of Russia's foreign exchange reserves, then later the seizure of those reserves, caused the Chinese central bank to pivot immediately. And this is a key aspect of it. Instead of recycling their trade surpluses into U.S. Treasury bonds, they accelerated their selling of those bonds. They were buying a lot more gold and shipped the gold back to China instead of leaving them on deposit in Western vaults. And they continue to buy through 2023 and today. These big blue lines are Goldman's estimates of China's central bank buys because they can't account for this volume across the normal market players. For example, in May of last year, the PBOC reported no gold buys, but Goldman believes that China's was 50 tons. Different factors are motivating different investors in different ways, but they are all bullish for gold. Western investors worried about higher inflation and trade wars are buying gold as a hedge. Central banks in China and India are buying gold because of the risk of keeping their reserves in liquid form held on deposit in Western banks. Retail investors in China are buying gold ETFs because it's one of the best performing asset classes. This is Huangshan, or Yellow Mountain in Anhui province. Be good.
Together we lift up the people of Asia. We pray that your spirit is poured out, that billion people are saved and brought to faith in Jesus Christ. We pray that you bring mentors and disciples